So an investment philosophy is far broader than a strategy. It's a way of thinking about markets. So if you think about why you need an investment philosophy, the reason is very simple. If you do not have an investment philosophy, and lots of investors don't, including most portfolio managers, here's what I think will happen to you. First, you're going to be easy prey for anybody trying to sell you that crystal ball or magic bullet. You've heard them, right? Just do this and you're going to make a ton of money. If you don't have an investment philosophy, you're going to get swayed by the next great salesperson who comes by, telling you that he has an investment strategy that works. Second, if you don't have an investment philosophy, you're going to tend to chase whatever worked last year. So you're going to pick the strategy that worked last year and you're going to try it. Then next year, you're going to try something else. The year after, you're going to try something else. You're saying, what's wrong with trying different things? Well, there are costs. In fact, the more strategies you try, the less chance there is any of these strategies will work for you. And you're going to end up with a ton of transactions costs and perhaps a very happy brokerage account. I'm going to argue that you can be successful with a variety of investment philosophies, as long as A, you've chosen a philosophy that fundamentally works, and second, you've chosen a philosophy that best fits your characteristics as an investor. The investment process always starts with the investor. So if you're managing your own money, it starts with you. If you're managing somebody else's money, it starts with that somebody. In particular, I'd like to know what your risk preferences are. Are you risk averse? How risk averse are you? What is your time horizon? Are you short term or long term? And don't tell me off the top that you're long term because it might be out of your control. And third, what kind of tax status do you have? Do you pay a high tax rate or a low tax rate? And the answer to that question might vary depending on which part of your portfolio you look at or when I look at you. So the key factors that drive the first step in the process is understanding the tax code and understanding the investor. Your investment philosophy can be a market timing philosophy, where much of your work is done at the asset allocation stage, or it can be an asset selection philosophy, where you believe that you can't time markets, but you can pick the right stocks, or the right bonds, or the right real assets. It can be activist investing or passive investing. This is not the same thing as active and passive investing. Activist investing, you actually take a position in an asset or a company and you try to change the value of the company. Most of us don't have that much power, but if you have enough money, you might try to do that. With passive investing, you invest in the best investments you can and hope and pray that those investments go up as much as you thought they would. And finally, investment philosophies can be short-term, medium-term, or long-term. And there's again no predisposition on my part to say long-term philosophies are better than short-term philosophies. If you can find a short-term philosophy that works for you, all the more power to you. The first step is to lay the foundation. To lay the foundation, you need to be able to understand risk and incorporate risk into your decision making. I'm not talking about just understanding risk and return models in finance. You might never use them, but you might still be able to understand risk. Second, you need to understand financial statements. You cannot invest in stocks without understanding basic accounting statements. And third, you have to understand the process of trading. What are the costs of trading? What are the frictions? Why might your strategy not work in the real world? Second step, develop a point of view about how markets work and where they might break down. Markets make mistakes. Or maybe they don't. If you believe markets don't make mistakes, your investment philosophy might become a very simple one. Just invest in index funds and move on. But if you believe markets make mistakes, you have to start fleshing out what types of mistakes they make and why they make those mistakes. And then find the philosophy that best fits you. That's the key. Best fits you. In what sense? Look at your risk aversion, look at your time horizon, look at your tax status. Generally speaking, the more risk you can afford to take because you have time as an ally to average things out. So let me wrap up. To be a successful investor, you need an investment philosophy. An investment philosophy is a way of thinking about markets, about thinking about how they work and how they don't work. And the investment philosophy that's right for you will depend on how risk averse you are, what your time horizon is, and what your tax status is.